9 super investors are investing in Blackstone and KKR, the largest and second largest alternative asset managers in the world. In addition to such popularity, the fact that it's the second largest position of ValueAct Capital, an activist hedge fund, and that Chuck Akre, known to have good eyes for high-quality businesses, is invested for long-term, all make it worthwhile to study these companies. Today, I will do a deep dive business breakdowns, compare bull and bear theses, and explain the key differences between these two companies. Blackstone and KKR have over 30 years of successful investment track record, starting from the private equity business in the US. But now, they cover much wider asset classes globally. Because these two are very similar, I will first go through Blackstone as an example, and bring KKR into our discussion later on. Blackstone was founded by Steve Chargman in 1985. In the beginning, Blackstone focused on leverage buyouts, also known as LBOs. Based on the very high investment returns generated from LBOs, Blackstone expanded into other asset classes such as real estate, private credit, hedge fund solutions, infrastructure, and more. Blackstone is now the largest alternative asset manager with $951 billion of assets under management as of Q3 2022. Blackstone has three revenue streams. The first is management and advisory fees, which is receiving a fixed portion, usually 1 to 2% of assets under management. This is very stable revenue since it doesn't directly correlate with the fund's performance, and Blackstone will receive this fee even if the funds lose money, although this almost never happened in the past. The second, incentive fee or performance fee, is what Blackstone receives when it generates investment profit for its clients. For example, if Blackstone's $10 billion fund generates 30% investment return, so $3 billion in profit, then it will receive about 20% of that profit, so $600 million as an incentive fee. This fee aligns Blackstone's incentive to generate high returns for its clients. Although this fee can be very profitable, it fluctuates a lot because investment returns can be volatile. Still, these first two revenue streams are highly profitable because Blackstone is basically investing other people's money and take a cut from the overall AUM and profits. That's why investors pay close attention to the fee-related earnings, also known as FRE, which is calculated by subtracting employee salaries and some other operating costs from the first two revenue items. Lastly, Blackstone makes money through investing its own money. But unlike the first two revenue streams, this third item can actually be negative from time to time, because some investments incur losses. And since Blackstone has to put down its own capital, this can be the most risky form of profit for the shareholders. Then you might ask, why even bother investing in this way? In reality, even if Blackstone doesn't want to invest its own money at all, it has to because its clients, mostly large pensions and endowments, as well as insurance companies, require Blackstone to put in its own money into the funds. Because in this way, these investors can be sure that Blackstone will manage the fund more responsibly, since its own money is also in the pot. After generating such revenue streams, Blackstone's operating expenses are quite straightforward, since it doesn't need to invest in any factories or inventories. It just needs to pay salaries and bonuses to its employees, pay some office costs and taxes, and the rest is all profit to shareholders. Although this sounds so simple, Blackstone has a flywheel that protects its business from competitors and creates stability. The starting point of this flywheel is generating stellar investment returns for its investors. As you can see here, for over 3 decades, its private equity funds more than doubled on average. And even the worst performed fund, launched at the peak of dot-com bubble in 2000, created 40% profit for investors. The same goes for its real estate funds, which also more than doubled money for decades. And here, the worst performance was 80% return to investors, which is actually not that bad. Based on such high returns, Blackstone has won investor confidence from the largest institutional investors all around the world. As a result, although Blackstone managed only $88 billion when it first went public in 2007, its AUM reached $439 billion by 2018, and since then, it has more than doubled to $951 billion, and is expected to reach $1 trillion in just a few months. Because Blackstone can accumulate such large sum of money to invest, it can also hire the best people in the industry and innovate new asset classes, which in return help to generate even higher returns in the future. Now, let's check if this innovation is actually happening at Blackstone. As mentioned previously, Blackstone started out with only private equities LBO strategy, and this business line grew significantly to over $280 billion of AUM. However, as the company kept innovating and adding new strategies, the private equity business is now only a small portion of the big picture. How did this happen? John Gray is the key man who started Blackstone's real estate business. And in the early days, instead of just investing in the usual assets, such as office, retail, or housing, he took a very different approach. For example, in the early 2000s, Blackstone knew that e-commerce is picking up in a big way, but the traditional warehouses and logistics network were not sufficiently prepared to handle the increasing volume. So, instead of investing in e-commerce companies that already had high valuations, Blackstone aggressively invested in the logistics network and generated very high investment returns. Investing in such assets has now become popular, and there are large public REITs like Prologis and Stag Industrial that only focus on warehouses. But 10-20 years ago, Blackstone's approach was quite innovative, and thanks to the continuing improvements, it's now one of the most successful real estate managers in the world. And John Gray has become a billionaire and the president and COO of Blackstone. This saga is a good example of Blackstone's flywheel in action, and it continues to spin the flywheel in other areas like the private credit and insurance, which already manages $269 billion, and also in new areas such as tactical opportunities, infrastructures, and life sciences. Now, let's move on to the bull thesis. Inevitably, at the core of the bull thesis sits on this flywheel, and bulls focus on the three positive factors that come out of this structure. The first is economies of scale. Blackstone and KKR are so big that by just sitting on their current AUM without any growth or investing success, they can receive $3 to $6 billion of very stable management fee every year. This economies of scale creates positive operating leverage the following way. As we saw before, management and incentive fees are major sources of revenue, and these fees increase proportional to the AUM. And from here, companies pay operating expenses and end up at the FRE. And because the operating expenses are quite sticky, because it's mostly salaries, so if fee revenue grows by 30%, operating expenses can do with only 10% increase, which results in much larger FRE growth that benefits shareholders. To see this operating leverage in action, in 2008, Blackstone generated only 34% FRE margin, but as its AUM grew, the FRE margin also increased from 34% to 45%. And as the AUM grows even further, FRE margin continues to improve to about 56% now. And in KKR's case, this margin is already at 67%, which Blackstone is also expected to reach in just a few years. So thanks to the economies of scale and operating leverage, Blackstone and KKR can not only grow in size, but also become more profitable as it grows. The second bull thesis relates to the inflationary environment we are in. As Ray Dalio and Michael Burry, in addition to many other economists, point out, the current inflation can stay with us for many years. And what assets do well in such inflationary environment? The most obvious are hard, real assets such as infrastructure, energy, and real estate, which are all asset classes where Blackstone and KKR have significant footprints and expertise in. And being very smart investors, they already prepared their portfolio for the inflation. For example, they have much higher exposure to the energy sector than the overall market. And because they were expecting interest rate increase since last year, their private credit portfolio is almost 100% invested in floating rate debts, which actually benefit from interest rate hikes. And speaking of smart investment decisions leads to the third bull thesis, that these companies are also well positioned for the looming recession. This is because hundreds of billions of dollars is ready to be deployed as economic headwinds surface and market deteriorates further. As of Q3, total of $300 billion of cash is the dry powder, representing about 20% of each firm's total AUM. Having such a large cash pile is very important heading into a recession, because historically, capital deployed during difficult times, like the aftermath of IT bubble crash in the early 2000s, 2008 global financial crisis, and 2020 COVID lockdowns, all generated very high returns. Obviously, such positive results will benefit shareholders in a form of high incentive fees that will be paid out in the future. Now, let's move on to the bear thesis. The first is actually related to the last bull thesis we just discussed. Bears claim that although it's true that these firms may reap high return through the dry powder that's deployed in the next year or two, but investors have to wait at least 5 to 7 years for the profit to materialize, because private equity investment cycle is much longer than public funds. And in the meantime, the assets that are already invested may have to exit at a lower valuation, which may lower profits for the next few years. So if you invest in these companies now, you better have a very long term, at least 5 years of investment horizon to see the full benefit at the end. The second bear thesis is that these companies are overvalued. For example, Blackstone and KKR's price to earnings ratios are 26 and 41 times respectively, and KKR even reported a negative net income in the third quarter. Although this bear claim is true, we need to recognize that for these alternative asset managers, adjusted cash flow is more meaningful than the usual GAAP-based net income. This is because GAAP earnings, which works well for most normal companies, includes unrealized gains and losses that cloud the picture. Since these items are only on paper and are short-term fluctuations affected by the market volatility, most investors, as well as companies, focus on after-tax distributable earnings, which has focus on long-term and, more importantly, on actual cash profit. And good news is that companies calculate this number for us shareholders, and we can see exactly how they are calculated in the filings. For example, KKR shows these earnings adjustments on page 31 of its recent earnings presentation. More streamlined and cleaner version of this is on page 34, where we can see the logical flow from the FRE that we talked about before to various actual costs and taxes, all the way down to the after-tax distributable earnings. And if we use this adjusted number, Blackstone and KKR currently trades at 16 and 11 times of cash flow, which are much more reasonable, especially considering that they continue to grow the cash flow. The last points bears raise are that the share count and both firms are rising, mostly due to stock options given to the employees, and also that in the last 6 months, insider sellings are much larger than the insider purchases. These are all legitimate concerns, and so when we model out to calculate expected returns, we should consider these factors, especially the increasing share count, which can hurt shareholders if it's overdone. So here are the bull and bear theses on Blackstone and KKR. Because these two companies are so similar, I could cover all these topics at once. But now, I will explain the two key differences that you have to be aware of before making investment decisions. The first is their different approaches to insurance business. Insurance is important for these companies' future growth in AUM because, as you can see here, globally, insurance companies hold over $40 trillion of assets that needs to be invested. Since the sum of total AUMs that Blackstone and KKR currently manages is still less than $2 trillion, even tapping a small portion of insurance asset means very large growth potential. Traditionally, these two companies receive insurance assets indirectly into the existing funds that they manage, but more recently, they are taking more direct route to grow faster. Blackstone's approach is it contracts with insurance companies to manage their whole annuity portfolio. This is a simple approach since it's very similar to just increasing its AUM. However, KKR went a little bit further and actually bought the ownership of an insurance company called Global Atlantic in the early 2021. This is much more complicated because if we now invest in KKR stock, we own both alternative asset management business as well as a wholly separate insurance company. So, for example, if we look at KKR's balance sheet, it separates out the asset management and insurance operations assets, as well as their liabilities. Also, because insurance companies in general have lower valuation, KKR's lower multiple compared to Blackstone's is somewhat justified. The second key difference is the dividend policy. Blackstone's policy is simply paying out 85% of distributable earnings each year. So looking at its dividend history, we can see that the payout ratio is stable at around 85%. But because its distributable earnings fluctuate from year to year, its dividend also fluctuates with it. Also, if you think about it, 85% payout ratio is quite high for a growing company. And this is why Blackstone's current dividend yield is high, around 6.5%. KKR used to have a similar dividend policy, so its dividend fluctuated with changes in earnings. However, starting in 2016, KKR lowered its dividend and made it stable at about 60 cents per share. That's why KKR's dividend yield is so much lower at 1.2%. Looking at this, one might decide that Blackstone is much better investment, and it may be true for dividend-conscious investors. However, if we look at super investors' choices, only 3 funds invested in Blackstone, while 7 chose KKR. Although we can't be 100% sure why KKR is more preferred, but paying attention to Chuck Akre's speech at Google provides a good hint, because his fund is still increasing its investment position in KKR while not touching Blackstone stocks. In that speech, Chuck says the long-term compounding of wealth is what investors should aim for, and he lays out 3 factors that can create long-term compounding. He calls this 3-legged stool investing. And first, the business has to be high quality, which can be measured in high ROEs. Second, it needs to be managed by high quality people. And third, the company has to continuously reinvest at high ROE, rather than paying out the profit. He specifically says that buying companies that compound at mid-teens, and if we are able to buy them at upper teens multiple, it's a very good combination. And now, let's apply this to Blackstone and KKR. These 2 companies seem to satisfy the first 2 categories. However, as we saw in the dividend policy, they are quite opposite in the 3rd category, because Blackstone returns most of its profit, 85% of it to be more precise, to shareholders every quarter. But KKR chose to step away from the high dividend and reinvest the excess capital year after year. This is obvious from its dividend policy, but we can also see KKR's reinvestment effort in its management presentation. It lays out how KKR reinvests shareholder capital to various asset classes. So instead of receiving the profit right away as dividends, KKR shareholders should expect mid-teens or even higher returns from the reinvestment. That's because, as we can see here, KKR has a long history of generating high return from its alternative investments. So, since KKR is a business that compounds wealth at mid-teens, and we can currently buy the stock at low teens multiple, it definitely fits what Mr. Akre looks for in long-term compounders. And this may be why most super investors chose KKR over Blackstone. Having said that, we can't just say that KKR is always a better investment than Blackstone, because each investor has different dividend needs and preferences. So dividend investors would appreciate Blackstone's 6.5% dividend yield more, while long-term investors would prefer KKR's ability to compound wealth at mid-teens for many years. I hope this analysis helps you making an informed decision about these 2 companies. Alright, that's gonna do it for today's video, and thank you all for watching. I really do appreciate it. If this video benefited you in any way, please click the like button below and also subscribe to the channel. And I will deliver deep dive numerical analysis on companies that are chosen by super investors. Also, feel free to share your thoughts on Blackstone and KKR. Are you buying them? Which stock did you ultimately choose and why? Please share in the comments. Okay, thanks again, and I'll see you next time. Take care.